In Baltimore, job growth levels are picking up and home sales are slowing down, and yet apartment fundamentals continue to cool off. So what is going on in the Charm City? Welcome to Apartment Market Dynamics from MPF Research. I'm Jay Parsons with your Baltimore update. First, the good news, Baltimore is producing very healthy job growth. The metro added 30,300 jobs in the year ending February 2013. That was one of the metro's best performances over the past decade, topped only by the number seen 2 years ago back in Q1 of 11. The past year's total expanded Baltimore's employment base by 2.3%. Very healthy number, and that came in spite of downsizing in Baltimore's public sector, so the private sector is carrying the load. And the other good news for the apartment market is that single-family home sales have slowed down a bit, at least in Q1 2013. As of February, home sales were down 4.4%. That's not too big of a surprise given that home sales never really tanked in Baltimore during the recession, and so they're not going through a big correction period right now like a lot of other markets are. But this also means that Baltimore probably isn't at risk of seeing huge pent-up demand for single-family homes and seeing a lot of renters leaving for home purchase, as is the case in some other markets. Now, all that said, despite these tailwinds, the Baltimore apartment market is not seeing much benefit. Let's start with occupancy. Quarterly occupancy change has been flat or slightly negative in 5 of the past 6 quarters, down 40 basis points in Q1 and down 30 basis points year over year. That brought the occupancy rate to 95.1%, a good number, but Baltimore's weakest in 9 quarters. And the slowdown has been pretty universal, with most submarkets and product niches logging declines. And as a result, same-store rent growth levels continue to ease. Same-store rents up just 2.2% year over year as of Q1, Baltimore's weakest increase in 12 quarters and 40 basis points below the U.S. average. Baltimore had been one of the national leaders for rent growth back in 2010 and was still performing well in 2011, but they've really softened since then. And like occupancy, the slowdown has been pretty universal among submarkets and product niches. So what's happening? Well, 2 key things. Number one, we see time and time again that consumer sentiment and operator sentiment plays a big role in apartment performance. How a consumer feels about the economy shapes decisions like whether to decouple a household and to lease up another apartment, or a young adult's decision to leave home from mom and dad and rent an apartment of their own. And it also affects operators' willingness to raise rents. And so obviously in Baltimore, it's attached to the hip to DC, and there's been a lot of talk in the DC-Baltimore area about sequestration and government job cuts, and so that negativity in the news plays a big role in shaping sentiment in the area, particularly with the talk about government cuts. That affects federal government spending and some key sectors of Baltimore's economy, defense spending, government contractors, research, and we've already seen some cutbacks in government jobs of late, so it could be that this news is offsetting the news about the private sector showing some growth, and that's affecting sentiment a good bit. Now, secondly, the other big issue is apartment construction. Since Baltimore got off to a strong start coming out of the 08-09 recession, development jumped up quickly. The market has seen 4,000 to 5,000 units underway per quarter since the start of 2012, around the time when rent growth levels really dropped off. And these are big construction numbers for Baltimore. This is easily the metro's biggest development wave in more than 2 decades, and that certainly dampens apartment fundamentals. So what does all this mean for the year ahead? Well, we're expecting basically more of the same. With all of this economic uncertainty plus the increase in construction, look for apartment occupancy to continue to trend down slowly and for rent growth levels to remain under 3% annually. Still pretty solid overall apartment fundamentals, but not spectacular like they had been back in 2010. And that wraps us up for Baltimore. So until next time for MPF Research, I'm Jay Parsons. Thank you for watching Apartment Market Dynamics.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.